Hi and welcome. In this video, we will summarize the main principles of the lease standard IFRS 16 that has been here since 2016. I am Sylvia of cpdbox.com, the learning platform teaching you to apply international financial reporting rules, helping you to pass your exams, answer your questions, get your CPD, so please visit cpdbox.com. So the new standard IFRS 16 has been applicable for all periods starting on or after 1st January 2019. So IAS 17 leases no longer applies. And there were a few amendments in this standard since its first publishing, and they deal mostly with COVID-related concessions and IBOR reform, which is a reform about interbank interest rates. But these amendments do not affect main principles of this standard, so they more or less provide guidance for these specific situations. The objective of IFRS 16 is to specify the principles for recognition, measurement, presentation, and disclosure of leases. And before we start explaining them, let me show you a few scope exceptions. So IFRS 16 does not apply to various types of arrangements as I'm showing you here. And for these types, different standards or rules apply, as you can see here. So these are mandatory exceptions of this standard, but there are two optional exemptions. So you can really choose for these two types of situations whether you will apply the rules of IFRS 16 fully or not. And these are leases with a lease term of 12 months or less with no purchase option. So this choice is valid for entire class of underlying asset. For example, for all motor vehicles leased below 1 year. In other words, you can apply IFRS 16 for one vehicle and not apply it for another vehicle. And the second exemption is leases where the underlying asset has a low value when new, such as personal computers, and this is done on one-by-one basis, so not for the whole class. I think it's good to have these exemptions because that will make accountants' life easier. Instead of worrying about some right-of-use asset, you will simply account for these lease payment on straight-line basis. Now, at the inception of each contract, an entity shall assess whether the contract contains a lease or not. So basically, a contract contains a lease if it conveys the right to control the use of an identified asset for a specified period of time in exchange for consideration. And then the standard clarifies how to determine the lease term, how to separate non-lease components and other issues. But let's focus on the accounting for leases once you identify there is a lease. And we will start with accounting by lessee. So the big change in IFRS 16 in comparison with older IAS 17 is that all lessees do not classify the leases into finance and operating anymore. No classification. Lessees need to account for all the leases in the same way, well, except for two optional exemptions that I mentioned about a minute ago. So at the commencement of the lease, the lessee recognizes both the right-of-use asset and the lease liability. So here you can see that even when the lease is operating, according to previous definitions, lessee always recognizes some asset. And that's a huge change because before, lessee recognized all payments under operating leases straight in profit or loss. The right-of-use asset shall be equal to the lease liability, and we'll show how to measure it in a minute. And then you should add a few other items that you can see here on the screen. So for example, I get lots of questions like what to do when we prepay the lease for 3 years and then we do not pay anything. Well, in this case, this prepayment is a lease payment before the commencement date of the lease, and it forms a right-of-use asset, so you would have close to zero lease liability. That's possible. The lease liability are, in fact, all the payments not paid at the commencement date, discounted to a present value using the interest rate implicit in the lease, or incremental borrowing rate. So what comes to the payments not paid at the commencement date? You can see the list of items here, and these would be fixed payments, variable payments, like depending on some index or rate, and a few other items. Subsequently, after the commencement of the lease, lessee needs to take care about right-of-use asset And here the most common entry is the debit depreciation expense in profit or loss and credit right of use asset accumulated depreciation account. And this is the application of cost model under IAS 16, but you can also apply fair value model under IAS 40 or revaluation model under IAS 16, depending on what you apply for your property, plant and equipment and investment property and what your right of use asset is. Don't forget about impairment testing under IAS 36. With regard to a lease liability, a lessee needs to account for interest on the lease liability using the constant periodic interest rate. So you debit profit or loss, interest, and credit lease liability. Plus, lessee needs to reduce the lease liability by the payments made. So the entry is to debit lease liability and credit cash or bank account. Of course, lessee may need to adjust both right of use asset and the lease liability for remeasurements or modifications that happen later in the contract. And these would be various inflation adjustments in the rentals or changing the lease term. And these items are treated based on their character. Now let's take a look at accounting for leases by lessors. Here, nothing much really changed comparing to the previous standard. It means that you need to classify the lease first and then account for it based on the classification. So the principal question is, are substantially all rewards and risks of ownership of the leased asset transferred to the lessee or not? If yes, then the lease is finance lease, and if not, then the lease is an operating lease. And you should answer this question right at the inception of the lease. So luckily, IFRS 16 states about 5 basic situations that normally lead to the lease being classified as finance. And if only one of these situations happens, then the lease is finance. And these situations relate to the transfer of ownership, purchase option, and other characteristics in the lease contract that you might need to assess if you are a lessor, not the lessee, all right? How should lessor account for a finance lease? Well, in the same way as under IAS 17, nothing very new here, so let me recap. At the commencement of the lease, lessor is a finance provider, and therefore he recognizes lease receivable, and that's the debit side of the entry. And the lease receivable is in fact net investment in the lease, which is the total of fixed payments, variable payments, and a few other items as you can see here. All these items are in fact payments not paid at the commencement date, and they should be discounted. And then the lessor should add the initial direct cost to the investment in the lease. The credit entry would be then the underlying asset. What about subsequent measurement? We have a lease receivable to take care about, so we have to split the lease payments received between the reduction of the finance lease receivable and finance income. And again, constant periodic rate of return shall be maintained. Now let's take a look at operating lease, which is much easier. Lease payments received from the lessee are recognized as a revenue in the profit or loss, basically on a straight line basis or some other systematic basis. And let me remind you that the lessor keeps the asset in his own financial statements and depreciates it. So yes, under the new IFRS 16, it can easily happen that both lessor and lessee will recognize some asset in their own financial statements. That's called asymmetric accounting. Now, let's take a look to sale and leaseback transactions. There's a transaction in which the seller sells the asset and then he leases the same asset back. And the asset, in fact, does not need to move. And in this case, the seller becomes a lessee and he takes the asset back under the lease. The other party is a lessor. The accounting treatment of sale and leaseback strongly depends on whether the transfer of asset is a sale under IFRS 15 or not. So if the transfer of an asset is a sale under IFRS 15, so it means that control of asset was transferred, that the seller or lessee recognizes a right of use asset at the proportion of the previous carrying amount of the asset relating to the right of use asset retained by the seller. And seller also recognizes gain or loss related to the right transferred to the buyer. Then buyer or lessor recognizes a purchase of an asset under applicable standards and accounts for the lease under IFRS 16. If the transfer of the asset is not a sale, then the seller or lessee continues to recognize an asset and the accepted payment is accounted for as a financial liability under IFRS 9. So it's a sort of a financing arrangement. The buyer or lessor also recognizes a financial asset under IFRS 9. So this was a very short summary of IFRS 16. This standard contains a lot of more detailed rules and specifications. So if you'd like to learn more, please visit the website cpdbox.com, subscribe to our free newsletter, and please share this video with your friends if you liked it. Bye, and thanks for watching.